So now we're looking at debtors. Now debtors within a three-way financial model is where we adjust for the differences between when revenue is earned and when it is received as cash. Now when we first bring our historical debtor balances into your financial model via your accounting package, it's brought into the historical balance sheet in the debtors section within the current assets, as you can see here. In this example, we have one category of debtors, that being trade debtors, and we have its historical balance spanning across the right-hand side of the sheet here, with a closing balance in June 22 of 1893.5. And when we're handling the forecasting of debtors, that is handled on our working capital sheet. Now firstly, let's look at the financial statement impacts of debtors within a three-way financial model before jumping into our example. A key point to note is that debtors is just an adjustment to the balance sheet and cash flow statement and does not affect the P&L or profitability of a business. As an example, if we had $100 of revenue within a period for a business, but we only received $20 of that in cash, we would then need to adjust for the remaining $80 owed to us as debtors on the balance sheet. As we can see here, debtors is an adjustment within the current assets of the balance sheet and also within cash receipts within the operating section of the cash flow statement. As we can see within the cash flow statement, our $100 of revenue less our adjustment for $80 that is still yet to be received shows a net change in cash of $20. Now hopping back to our example, when most people think of debtors analysis, they think of debtor days as the calculation method. This is commonly used, however, in the context of a monthly financial model, if you have a highly cyclical business, or if you have a long period over which you receive revenue that is earned, using debtor days can lead to some strange adjustments within the cash month to month. This is why within a monthly model, we use a cash receipt delay method. The cash receipt delay method assumes that invoices are sent evenly throughout a period, and each invoice is received after an assumed number of days. To break down our debtors analysis here, we're first going to wipe everything down to zero so it's easier to step through together. Now that our debtors analysis is wiped down to zero, we can see that we're assuming all revenue is received as cash and nothing is flowing through our debtors analysis. You can see we still have our opening balance of 1893.5, however this is not currently being received throughout the model. Our first assumption here in column I determines over what period will we receive that opening balance. If we assume that we're going to receive that opening balance over one day, then you will see that the cash receipt of that entire balance happens within the month of July. In the same vein, if we assume we're going to receive that opening balance over a period of 31 days, then the entire balance is still received within the month of July. If we assume we're going to receive that opening balance over 62 days, as there are 31 days in July and August, you will see we have an even cash receipt of the opening balance across the 2 months of July and August. So that's how we account for the receipt of our opening debtors balance, which we've brought through from our accounting package. So now let's look at how we adjust for the receipt of forecast revenue within the financial model. For this, let's allocate just wrong sales to flow through the trade debtors balance so we have forecast revenue to work with. Now as our forecast cash delay is still 0 days, there is no change in our debtors balance as we're assuming all forecast revenue for just wrong sales is received as cash. Now let's look at October 22 as an example. We have 679.8 of just wrong sales being forecast for the month of October. Using a cash receipt delay mechanic, we assume that 679.8 is spread evenly across 30 invoices sent out throughout the period. If we enter a cash receipt delay assumption of 45 days, that is saying that of each of those invoices is received 45 days after it was sent out. That is, the first invoice, which would be sent out on October 1st, is then received 45 days later, which would be the 15th of November. Following this forward, we can then see that the 679.8 is received across November and December, with 350.9 received in November and 328.9 received in December. If we then apply that cash receipt delay assumption of 45 days across the entire duration of the model, you will then see our debtors balance comes to life. We then have a change in our debtors balance each month, reflecting the receipt in cash from 45 days prior, as well as the adjustment for the forecast revenue in each month, which is then going to be received 45 days in the future. If revenue is received quicker than 45 days, then we can adjust our assumption to 30 days. You can see here then that we have a lower debtors balance each month. As we are assuming that it takes us less time on average to receive revenue that we have previously earned, we then have a lower amount outstanding to us at any point in time, reflected by the lower closing balance of debtors. Now when we're looking at the financial statement impacts, it's key to emphasize that debtors is simply an adjustment to the cash flow and balance sheet and does not affect the P&L of a business. It is a reflection of the differences in cash payment timings between when revenue is earned and when it is received as cash. The other area to consider is whether we have GST included within the model. If you have GST within your model, then your debtors balance will increase as they also owe you the GST on your sales as well as the revenue itself. To recap, when we're looking at the financial statement impacts of debtors analysis within a three-way financial model, debtors is an adjustment to the balance sheet and the cash flow statement. An adjustment to cash receipts within the operating section of the cash flow statement This adjustment to cash is matched with an increase in our debtors balance on the balance sheet, therefore not changing net assets or the net profit of a business. It is simply an adjustment to the cash and balance sheet.